The auction ended at 1 p.m. By 1:03 p.m., mortgage rates had spiked. Nobody sold a house. Nobody defaulted on a loan. The economy didn't collapse. But in those 3 minutes, the cost of borrowing for 330 million Americans shifted upward because of a single number that most people will never hear about. That number is called the tail. In this investigation, you will learn exactly how a government debt auction, an event that happens multiple times every single week, can move interest rates across the entire economy in minutes. You will understand why the gap between what the Treasury expects and what dealers are willing to pay creates a shockwave that hits your mortgage, your credit card, and your savings account. And you will see why the invisible balance sheets of 24 primary dealers control more of your financial life than any central bank decision. This is not about the Federal Reserve. This is not about inflation data. This is about plumbing, broken plumbing. And when the pipes crack, everyone downstream gets flooded. Educational only, not financial advice. Let's define the normal world. Every week, the United States Treasury needs to borrow money. They do this by issuing bonds, IOUs that promise to pay interest over time. These bonds are sold at auctions. Investors bid. The highest bidders win. Simple. But here's the detail most people miss. You cannot just log onto a website and buy a Treasury bond during the auction. The auction is not open to the public in that direct sense. Instead, it is mediated by a group of 24 elite financial institutions called primary dealers. These are the giants: JP Morgan, Goldman Sachs, Citigroup, and others. They have a special license. They are required to bid at every single Treasury auction. Here's how the flow works. The Treasury announces an auction. Let's say they are selling $10 billion of 10-year bonds. The dealers submit bids. Some bid high, some bid low. The Treasury accepts bids starting from the highest price, which corresponds to the lowest yield, and works its way down until all $10 billion are sold. The final accepted bid, the lowest price or highest yield, becomes the benchmark. This is the rate that sets the tone for all other interest rates in the economy. Mortgages are priced off this rate. Corporate bonds are priced off this rate. Car loans, student loans, everything floats on top of this number. Now, in a perfect world, the auction clears smoothly. Demand is strong. Dealers compete aggressively. The final yield is close to what the market expected before the auction started. But sometimes, the auction does not go smoothly. And that is when the system reveals its weakness. This is where the tail appears. The tail is the difference between the average yield of all accepted bids and the yield of the final worst bid that was still accepted. It measures how much the Treasury had to sweeten the deal to get the last dollar sold. A small tail, let's say 1 or 2 basis points, is normal. It means demand was healthy. Dealers were competing. The market absorbed the supply without stress. But a large tail, 5, 7, 10 basis points, is a warning sign. It means dealers were hesitant. They demanded a higher yield to take the bonds onto their balance sheets. Why does this hesitation matter? Because primary dealers are not buy and hold investors. They are intermediaries. Their business model is to buy bonds at the auction and immediately resell them to end buyers: pension funds, foreign central banks, insurance companies, retail investors. The dealers make money on the spread. They do not want to hold inventory. But here's the constraint. Dealers operate under strict capital rules. When they buy a bond, it sits on their balance sheet. That bond consumes balance sheet capacity. It ties up capital. It creates regulatory costs. If the dealer's balance sheet is already crowded, maybe because they are holding lots of corporate bonds or repos or other securities, they become less willing to absorb new treasuries. They bid lower prices, which means higher yields. Now imagine the scenario. The Treasury holds an auction. Demand is weak. Maybe foreign buyers are pulling back. Maybe domestic funds are cautious. The dealers realize they might get stuck holding billions of dollars of bonds that they cannot quickly offload. So they bid cautiously. They demand a yield premium, a tail, to compensate for the risk of being stuck. But here's where it escalates. The moment the auction results are published, the entire market sees the tail. Traders on screens across the world see that the Treasury had to pay up. They interpret this as a signal. Either demand for U.S. debt is weakening, or dealer capacity is constrained, or both. Either way, the implication is the same. Yields need to be higher to attract buyers. Within minutes, bond prices adjust. The 10-year yield ticks up. And because every other interest rate is priced off the 10-year, everything else adjusts too. Mortgage-backed securities reprice. Corporate bond spreads widen. Swap rates shift. The entire yield curve moves. And this isn't a slow drift. This is a step function. In one moment, rates are stable. The next moment, they are 5 or 10 basis points higher. The tail from a single auction has repriced trillions of dollars of debt. But here's what no one tells you. The tail is not just about supply and demand for bonds. It is about the balance sheet capacity of 24 institutions. If those institutions are constrained, if they are already holding too much inventory, or if regulatory costs have gone up, or if their funding costs have spiked, they will demand a higher yield, and that higher yield becomes the new floor for the entire economy. This is the hidden mechanism. The Treasury does not set rates. The Fed does not set rates in this direct sense. The 24 dealers, through their willingness or unwillingness to intermediate, set the marginal price. And that marginal price governs everything. Now let's go deeper into why dealer balance sheets matter so much. Think of a primary dealer as a specialized warehouse. They have limited space. Every bond they buy takes up room. Regulatory rules determine how much room they have. These rules are called capital requirements. They say, for every dollar of bonds you hold, you must set aside a certain amount of capital as a cushion. When capital is cheap and plentiful, dealers can expand their warehouses. They can take on more inventory. They can bid aggressively at auctions. But when capital becomes expensive, when banks are under stress, when regulations tighten, when risk appetite declines, the warehouse shrinks. The dealers become choosy. They only bid for bonds they know they can flip immediately. Here's the catch. The Treasury doesn't care about dealer capacity. The Treasury has a funding schedule. They need to sell a certain amount of debt every week to keep the government running. If dealers are constrained, too bad. The auction still happens. The bonds still need to be sold. And if dealers are reluctant, the Treasury has to offer a higher yield to entice them. This creates a one-way ratchet. When dealer capacity is abundant, auctions clear smoothly. Tails are small. Yields stay low. But when dealer capacity is scarce, auctions become stressful. Tails widen, yields jump. And once yields jump, they rarely come back down quickly. Because the market has now repriced risk, the new higher yield becomes the baseline. Now let's trace the domino effect. The auction clears with a large tail. Yields spike. What happens next? First layer, the mortgage market. Mortgage rates are priced off the 10-year Treasury yield plus a spread. When the 10-year yield jumps, mortgage rates follow within hours. Lenders reprice their rate sheets. A borrower who was quoted 6.5% yesterday is now quoted 6.65% today. That might sound small, but on a $500,000 loan, it is hundreds of dollars per month. Demand for mortgages softens. Home sales slow. Second layer, corporate borrowing. Companies that were planning to issue bonds see the yields rise. Their cost of capital just increased. Some delay their bond sales, some cancel them. Projects get postponed, hiring plans get revised. The economic ripple spreads. Third layer, the dealers themselves. Remember, they are stuck holding inventory. They bought bonds at the auction expecting to flip them quickly, but if the market is weak, they cannot sell without taking a loss, so they hold. This ties up more balance sheet. It makes them even less willing to bid aggressively at the next auction. The problem compounds. But here's the part that most people do not see. The dealers fund their inventory with short-term borrowing. They use the repo market. In a repo, a dealer borrows cash overnight using the bond as collateral. The interest rate on that repo is the dealer's cost of funding. If the repo rate is low, the dealer can afford to hold inventory cheaply. But if the repo rate spikes, maybe because of stress in money markets or because the Fed is draining liquidity, the cost of holding bonds becomes prohibitive. The dealer is forced to sell. They dump bonds into the market. Prices drop. Yields rise even further. This is the feedback loop. Weak auction creates a tail. Tail signals weak demand. Market reprices higher. Dealers get stuck with inventory. Dealers face rising funding costs. Dealers become even more cautious at the next auction. The next auction has an even bigger tail. The spiral tightens. And now the really dangerous part. If this dynamic persists, it starts to question the creditworthiness of the United States itself. A large tail is not just a technical glitch. It is a sign that the market is demanding a higher risk premium to hold U.S. debt. If the tail becomes structural, if it shows up auction after auction, investors start to ask, is there a buyer of last resort problem here? Historically, the answer has always been yes, there is a buyer of last resort, the Federal Reserve. The Fed can step in and buy treasuries to stabilize the market. But the Fed is also trying to fight inflation. It is trying to drain liquidity, not add it. If the Fed is forced to intervene to support a failing auction, it undermines its entire policy stance. This is the trap. The Treasury needs to borrow. The dealers need to intermediate. The Fed needs to stay out. But if dealer capacity is constrained, the system breaks. And when the system breaks, the tail is the first symptom. Well, let's look at another angle. The auction tail also affects international confidence. Foreign governments hold trillions in U.S. treasuries. They watch these auctions closely. When they see a large tail, they interpret it as weakness. They start to question whether the U.S. can continue to borrow at favorable rates. Some begin diversifying their reserves. They buy gold. They buy euros. They reduce their dollar holdings. This diversification puts additional pressure on Treasury demand. It creates a self-fulfilling prophecy. Weak auction leads to reduced foreign buying, which leads to weaker future auctions. The cycle accelerates. And the Treasury is forced to keep offering higher yields to compensate for the shrinking buyer base. Now think about the timing. Auctions happen on a regular schedule. The market knows when they are coming. Sophisticated traders position ahead of auctions. If they expect dealer capacity to be tight, they short treasuries in advance. This pre-auction selling pushes yields higher even before the auction starts. The Treasury walks into the auction already facing elevated yields. The tail becomes almost guaranteed. This is market front-running. It is legal. It is rational. But it amplifies the problem. The fear of a weak auction creates the conditions for a weak auction. The dealers see the pre-auction selling. They become even more cautious. They bid even lower. The tail widens further than it would have otherwise. Now let's bring this down to the everyday level. Why does this matter to someone who is not a bond trader? Scenario 1. You are shopping for a mortgage. You were pre-approved at a certain rate. You found a house. You are ready to close. Then an auction goes poorly. The tail is large. By the time you lock your rate, it is 20 basis points higher than it was last week. Your monthly payment just increased by $150. Over 30 years, you will pay tens of thousands of dollars more. You did nothing wrong. The economy did not change. A plumbing issue in the Treasury market just made your life more expensive. Scenario 2. You run a small business. You are planning to take out a loan to expand. The bank quotes you a rate based on current market conditions. Then, the auction tail spikes. The bank reprices. Your loan is now more expensive. The expansion is no longer profitable. You cancel the project. Jobs that would have been created do not materialize. Scenario 3. You are saving for retirement. You have money in a bond fund. The fund holds treasuries. When yields spike, bond prices drop. Your account balance falls. You did not take any risk. You were holding the safest asset class in the world. But the mechanics of dealer balance sheets just eroded your wealth. These are not hypothetical. These are the transmission channels through which an obscure auction detail becomes a household economic event. The tail is not just a number on a Bloomberg terminal. It is a lever that moves the entire cost structure of the economy. And here is the wealth transfer angle. When yields spike, existing bondholders lose. The value of their bonds drops. But new buyers win. They lock in higher yields. This is a redistribution from savers to new investors, from the people who are already in to the people who are getting in now. The tail accelerates this transfer. Consider also the psychological impact. When households see their borrowing costs rise suddenly and without clear explanation, it creates uncertainty. People delay major purchases. They postpone home buying. They reduce spending. This slowdown feeds back into the economy. Businesses see lower demand. They cut back on investment. The auction tail, through its impact on rates, can trigger a broader economic contraction. And there is another hidden cost. When the Treasury is forced to pay higher yields because of dealer constraints, taxpayers ultimately bear that cost. Every basis point increase in borrowing costs translates into billions of additional interest payments over time. Money that could have gone to infrastructure, education, or deficit reduction instead goes to compensating dealers for balance sheet risk. The auction tail is not a bug. It is a feature. It is the market's way of saying, dealer capacity is scarce, demand is fragile, and the Treasury needs to pay up. When the tail appears, it is not random noise. It is a signal that the plumbing is under stress. The rules of the game are simple. The Treasury needs to borrow trillions. The dealers have limited balance sheets. The buyers have limited appetite. When these three forces collide, the tail widens. And when the tail widens, every interest rate in the economy adjusts. You cannot control the auction. You cannot control dealer balance sheets. But you can watch the signals. Ours. 5 signals to monitor. 1. The size of the tail at each auction. A tail above 5 basis points is a yellow flag. Above 10 is red. 2. Dealer inventory levels. If dealers are already holding record amounts of treasuries, the next auction will be harder. 3. Repo rates. If overnight funding costs are rising, dealers will be less willing to intermediate. 4. Foreign buyer participation. If foreign central banks are reducing purchases, domestic dealers must absorb more. 5. Auction frequency. If the Treasury accelerates its borrowing schedule, dealer capacity gets stretched faster. In the next episode, we will explore what happens when the auction fails entirely, when the Treasury cannot sell all the bonds it needs, when the dealers walk away. When the backup buyer, the Federal Reserve, is forced to step in. That is the endgame scenario, and the signs are already appearing. The auction is not just a financing event, it is a stress test, and the tail tells you whether the system is passing or failing.